Now, we've been asked to prepare a published profit and loss account and balance sheet in accordance with the Companies Act and appropriate accounting standards, showing the following notes: accounting policy note for tangible fixed assets and stock, operating profit, interest payable, dividends, and tangible fixed assets. Now, this is fairly standard fare, guys. So we have to, some of the stuff we actually have to learn off by heart. So let's start and we do the tangible fixed assets. So here are the notes that you get. Buildings were revalued at the end of 2004 and have been included in the accounts at their revalued amount. Vehicles are shown at cost. Depreciation is calculated in order to write down the value of tangible assets over their estimated useful life as follows: buildings 2% straight line basis, delivery vans 20%. Stocks are valued on the first in first out basis at lower of cost and net realizable value. That's very interesting because you always value your stock at the lower of the cost you or its net realizable value. Now we've come across that in question 1 a lot. Now for 6, that was 6 marks. Operating profit. Operating profit is arrived at after charging depreciation on tangible assets of 58,000. So that was your depreciation charge for the year for both buildings and your vehicles. Paid and amortized 10,000. This is just a complete waste of a sheet of paper. Directors' remuneration 50,000 and auditors' fees 9,500. Now, then move on to interest payable. Interest payable on debentures which are repayable 2008, 2009, 16,000 is your 12,000 plus your 4,000. Your dividends. Now your ordinary dividends, the paid, which was your 15,000, and your interim preference dividend paid 9,000. So that was 15,000 and 9,000. That was in the trial balance. Now where did I get the 3.75 per share? That's 15,000 divided by 400,000 shares, and 9,000 divided that by 200,000. So that's 9,000 divided by, just to double check that, gave you 4.5 cents a share. Then when you did your final proposed dividend of 13,000 and your final proposed dividend of 9,000. So your 13,000 divided by 400,000 gave you 3.25 cents per share. Now, and there was only 4 marks going for that, lads, but that's not difficult. Now, I think this is the hardest part of the whole thing, which is the tangible fixed assets. And you look at land and buildings. Now, if you look at buildings at the start of the year with 700,000, that's as per the trial balance. But if you go down to the note, then we had buildings which cost us 80,000. So that was land and buildings was 780,000, the disposal was 80,000, and we revalued to 900,000. Vehicles were 220,000. Your opening depreciation at the start of the year is 42,000 and 33,000. Both of those are in the original side of the on the original trial balance. Depreciation for the year then was 14,000 and 44,000. There's your 58,000. Minus your transfer to revaluation reserves, it gives you a zero balance at the end for buildings and 77,000. Now, I wouldn't get too excited about the total side. You probably wouldn't have time to do it. But then you have to, for some strange reason, you're asked for the net book value at the start of the year and the net book value at the end of the year. The net book value at the start of the year, of course, right, is for land and buildings is 780,000 minus the 42,000. Right, that gives you 738. And so look, there's your 780,000 minus your 42,000. Then at the end of the year, you have 900,000 minus your closing depreciation, which gives you 900,000. Then your net book value for vehicles at the start of the year is 220,000 minus 33,000. And then it's 220,000 minus 77,000. Now that's it. All right. Now, there's a bit of speed. This question is not difficult, but you need to be fairly quick. Then look at the last part in part B, the director's report. A director's report must contain the following: the dividends recommended for payment, the amount to be transferred to reserves, a report of any changes in the nature of the company's business during the year. Now, I've given you this before in the previous submission to you. An exceptional item then, this is a material item of significant size. It is a profit and loss account. Must be shown separately in the profit and loss account because of its size. So again, now in some companies, for example, a material item might be less than €1,000,000, but that would be a very large company. But for a small normal business or a public limited company, £1,000,000 might be significant. So you're as often as well to show that if there's it's an exceptional item, you should really show it separately. But that brings us to the end of this question.